So I'm still long-term bullish, and I wouldn't say I'm big on crypto in general. I tend to be pretty skeptical of the majority of the crypto space. For me, it's so far been really Bitcoin and stablecoins that I think are the most interesting, and then there's little pockets elsewhere that are kind of also kind of interesting. But for the most part, it's pretty concentrated. I'm long-term bullish on Bitcoin still. Nothing's really changed with that thesis. The way that I'm interpreting this year is that the ETFs pulled forward a lot of excitement. People started to get really bullish in like February and March of this year. And we've seen kind of a slow draining of these kind of overinflated expectations since then.
Don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
The big metrics that Bitcoin tends to track, and actually I've commissioned a report from an analyst I like, and I'm advising it that we're kind of quantifying this a little bit more. But Bitcoin tracks global liquidity better than any other major asset class, so better than stocks, better than gold, better than emerging markets, better than bonds. And there's different ways to measure global liquidity. In that report and in general, I define it as global broad money supply, but denominated in dollar equivalents. So you get both a credit expansion or credit contraction component, and then you get that strength of that dollar relative to the other major currencies. And basically, if that goes up or down in a given 12-month period, Bitcoin has the highest likelihood of other assets to do the same direction, which is over 80% in Bitcoin's case. So I put a lot of that focusing on global liquidity when I'm thinking about, say, a 2-year or 12-month Bitcoin price. I don't really try to judge like month by month or quarter by quarter Bitcoin price. For the political component, obviously
Bitcoin's performance in relation to global liquidity is an area that Lyn Alden, a prominent investor and macroeconomic analyst, has explored in depth. Her perspective on Bitcoin is bullish, and she links this to a broader investment strategy that includes exposure to emerging markets. Alden's optimism regarding Bitcoin stems from its ability to closely track global liquidity trends, outperforming many other asset classes in this regard. In fact, Bitcoin exhibits a striking correlation with global liquidity, exceeding 80%. This makes it a more reliable indicator than most traditional assets when analyzing broader economic trends. Alden highlights that monitoring global liquidity is a crucial factor when predicting Bitcoin's price movements, especially when extending the time frame to 2 years. Global liquidity encompasses the availability of capital in the world's financial systems, influenced by central bank policies, interest rates, and credit conditions. As central banks inject or withdraw liquidity from the system, Bitcoin's price tends to respond in tandem. Thus, Alden's strategy involves closely following liquidity flows to make more informed predictions about Bitcoin's future value. Bitcoin's sensitivity to these liquidity conditions underpins its volatile nature but also makes it a potentially rewarding investment for those who understand the underlying economic forces at play. For Alden, keeping a close watch on liquidity trends and emerging markets helps shape a long-term view of Bitcoin's role in a diversified investment portfolio, particularly over multi-year periods. By focusing on global liquidity trends, investors can better anticipate Bitcoin's movements and navigate the volatility that often characterizes its price action.
Most Bitcoin conferences are not that political. This particular one that happened in Nashville it's the biggest one in the world, and it's during American election season. So this one was very political. I guess the interesting thing about it is that most of the headlines were the Republicans there. So obviously Trump was there. There are a number of senators and representatives that were there. But I think what went under the radar is that there were some Democratic politicians there as well, like Ro Khanna, for example. And then he and over a dozen other congressmen wrote a letter to the DNC saying that they need to embrace that industry a little bit better than they have. So right now, if you look at, there's actually a study recently by Troy Cross, a professor, and another professor, I can't remember his name, but they found that they kind of looked at a sample, pretty big sample, it was a well-designed test as far as I could tell, and they wanted to see if there was a difference between Bitcoin holders and the general public on a number of metrics, including politics, and they actually didn't find that much difference.
Really?
Yeah, the two biggest areas that stood out were Bitcoin holders skewed male and they skewed younger. But they didn't skew left or right, which was actually kind of surprising because when you look at politicians that embrace it, it certainly has. And I'm focusing on basically a couple different areas, some of which I think most investors are overstating and some that I think investors might be understating. So the interesting thing about this cycle is that during the rate hiking cycle, the economy was more resilient to the rate hikes than many people thought. And that was because a lot of the private debt was locked in at low long-term fixed rates. And ironically, a lot of the government debt wasn't. And so basically the raising rates increased the deficit more than it increased private sector interest expense that's locked in. Obviously, if you're entering the home buying market right now, that's a very different story. But when we look at the aggregate private debt out there, investment grade debt, a lot of it was unimpacted by these rate hikes, and only slowly quarter after quarter does some of it get refinanced at these higher rates. And I think we're going to have a similar effect on the downside, which is, cutting by 25 or 50 or even up, after a couple of cuts, even 100 basis points is still above, a lot of the rates that people have locked in. Now, obviously, the long end moves differently than the short end. But overall, until they kind of hit some threshold, I wouldn't expect a very large amount of refinancing, which you normally see during those rate cutting cycles, because people use the opportunity to get out of their higher price mortgages into lower price mortgages. They unlock more consumer spending, and there's just not a lot of that ready to be financed. There were very low mortgage originations over the past couple of years in this higher rate environment, so the opportunity for refinancing is fairly low. The area that I'm more wondering about on the optimistic side is foreign equities. Basically, there's been huge long period of U.S. outperformance, strong dollar environment, strong U.S. equities. Some of that's fundamental, some of that's valuation. A lot of it's capital flows. And one of the few periods where you get a chance for rotation into international markets is during rate cutting cycles.
The current landscape for foreign equities presents an interesting dynamic, driven by shifts in market conditions and investor sentiment. There is growing optimism surrounding foreign equities, particularly as the U.S. market's prolonged outperformance may begin to moderate, especially in scenarios where the Federal Reserve starts to reduce interest rates. This anticipated market rotation could favor non-U.S. equities, as global markets may offer more attractive opportunities for growth compared to the U.S., which has enjoyed a sustained period of capital inflows. One of the key factors that has historically supported U.S. equities is the strength of the U.S. dollar. A robust dollar environment tends to draw international investment into U.S. assets, as foreign investors seek the relative safety and stability of the American market. This dynamic, in turn, has funneled considerable capital into U.S. equities, further enhancing their performance relative to global markets. However, as market conditions evolve and interest rates potentially decline, there is room for this trend to reverse. A weakening dollar could make foreign equities more appealing, both to U.S. investors seeking diversification and to international investors who might find non-U.S. markets more accessible. As capital begins to flow out of the U.S., foreign equities may gain traction, leading to a more balanced global investment landscape. This potential shift underscores the importance of paying close attention to currency movements and the broader macroeconomic environment when considering investment strategies. Thus, while U.S. equities have been the favored asset class in recent years, the tide may be turning. Investors should remain open to the idea that foreign markets may soon present stronger growth prospects, especially in a context of rate cuts and a possible weakening dollar. This evolving scenario sets the stage for a more globally diversified investment approach.